What's good, everyone, and welcome back to the Financial Freedom channel. We are on our free money glitz series number 1, talking about the second part of fundamental analysis, sector analysis. In this portion, we'll learn about what a market sector is and how they can be useful to an investor. We'll also look at the major companies that are categorized in each sector and how to analyze the health of a sector compared to other sectors. So grab your notebooks, buckle up, hands and feet is out there at all times. Let's go glitch this money. So understanding the different market sectors is very important for an investor to basically help them conduct a useful analysis to enhance an existing portfolio or build a new investment portfolio. With that being said, there are two types of sectors that investors need to be aware of. So one is the economy sector, which is used to help analysis and economists understand the health of the economy. The primary sector of the economy sector includes mining and agriculture, basically any industry that extracts raw materials and harvests natural products from the earth is in this section. The second sector includes manufacturing, processing, construction. The third sector is like financials, retail sales. You got entertainment industry type things, Netflix, and the fourth sector of the service industry focuses on like business activity, including research and development, education, business consulting, data collection, whatever it may be. Then there's the market sector. So the domestic markets are categorized into 11 market sectors. Each of the individual companies are listed in one of the market sectors that form the base for the stock market. And in the previous section, we talked about the different investment industries that display certain types of behavior characteristics at different stages of the economic cycle. Each one of these industries can be categorized under one of the 11 market sectors. And it isn't uncommon for some of the industry types in each sector that weren't listed in the previous sector to perform better than the general market at different stages of the economic cycle. All right, so let's break down the market sectors and explain what they represent. So first, there's the information technology sector, which consists of companies that focus on research, development, and distribution of tech goods and services. Basically, companies that develop software, manufacture electrical goods like computer products and smartphones, as well as like home appliances and home entertainment. They basically all fall under this category. Then there's the material sector, which is made up of companies who discover and who process and who develop raw materials. Most of the companies are involved in mining and refining metal and chemical products. And also most of the construction material is supplied to other industries and companies. The financial sector provides financial services, obviously, to both commercial and retail customers. Money, insurance, investment advice can be provided by these services. The companies that fall into this category are like banks and credit unions. Real estate includes like equity REITs, real estate management, brokerage companies. Real estate related companies were initially listed under the financial sector, but the growth and importance of primary equity REITs and real estate necessitated a new sector headline. Then there's the healthcare industry, which includes companies that provide any medical services to treat patients, as well as produce drugs and medical equipment. This can also include companies that provide like preventative care for patients. So you got the Modernas of the world, the Pfizers of the world. They're in this sector. Then there's your consumer staples, which includes companies that produce and sell food. This is where these items are considered essential by customers, orange juice and things like that. With companies like supermarkets and even chemists fall into this sector as well. And then, of course, you have the energy sector, which basically produces or supplies energy like gas and oil, clean energy. This is also companies that are involved in exploration and development of oil and gas as well. So if there's enough disposable income available, consumer discretion is a category of companies that provide goods and services that are not essential to customers. Clothes, entertainment, holiday spending can be included in these items. So then there's the utility sector, which basically includes water, electricity, gas, those type of services. The government regulates some utilities companies to make sure that the public service nature of the sector is maintained. And then you have your industrial sector. In this sector, companies provide commercial and industrial equipment and services, as well as like transportation and logistical operations to other industries. Construction, airlines, railroads, waste management are some of the industries that are that the industrial sector supports. And then finally here, last but not least, you have the communications services sector, which has infrastructure and services for customers and businesses to transmit voice, transmit data, audio, video across the globe, fixed and mobile phone operations. You got internet service providers, cable, satellite businesses are also companies in this sector. Basically, once you understand what each sector entails, you can understand why some industries perform better than others at various points in the economic cycle. So given that this is an overview of the entire economy, it stands to reason that different sectors will require various economic conditions to operate effectively. Okay. So understanding these sectors highlights the importance of portfolio diversification. Okay. So when we are aware of the distinctions between the various industries, we can compare and contrast them with those that are anticipated to perform well at the same stage. Comparing industries that typically perform well at a certain time of year is very useful if we know that the market is at its economic peak. Okay. So as an example, investors have the opportunity to give healthcare stocks a heavier weighting if the sector at the height of an economic cycle appeared to be stronger than, let's say, the utility sector. All right. So another method of comparing sectors is by using the economic phases as a guide and looking at the upcoming phase to find weaknesses. So historically, utilities have outperformed the financial sector during a contraction phase and vice versa during a trough phase, right? So by using sector analysis, we can identify a rise in the financial sector performance and a decline in the utility sector's performance, right? And so we can use this kind of analysis to perform, or should I say, to determine when the phases may be changing in order to enter the market early, right? Potentially even profiting from a move into certain stocks, right? And exit the market or reduce the holding in other stocks, okay? So one of the best ways to analyze the health of a sector is to apply technical analysis to the sector itself. Although fundamental analysis can be used on individual sectors, the information isn't as easily processed as, let's say, technical analysis signals. And comparison between the sectors can be problematic. Early in the section, we listed the 11 market sectors. Now, when you type in the individual sector in your trading platform, a chart will display in much the same way as it does for a share. This allows the investor to carry out analysis based on technical signals to determine the strength and weakness in a sector. And so here is an example of a weekly candle chart of a utility sector. So furthermore, most trading platforms allow investors to compare different sectors overlaid on the same chart. In this example, it basically displays the financial sectors with an overlay of the utility and material sector on a weekly chart. This basically is a very powerful resource as investors can see it at a glance how each sector is performing relative to the other sectors, right? Another great comparison you can use is the S&P 500 compared to other international markets. As you can see the overlay on the chart, comparing sectors to the index is pivotal to isolate how each sector is trading compared to the indexing, and can also offer clues on potential changes in market dynamics, right? And so below here, you basically see the Australia market with a healthcare and financial sector overlay. So if you notice at the end of the 2000 year going into 2008 year, the financials began a steady decline into the contraction phase during the global financial crisis. But as expected throughout a contraction, healthcare continued to perform well, okay? So you will also notice that the finance sector underperformed even the index from the economic peak right through the contraction phase, which basically highlights the importance of sector analysis. So because we know which sectors perform well historically through the different phases of an economic cycle, this type of analysis can be invaluable to those who are trying to rebalance their investment portfolios for the best performance. So if you would like to know more about the technical analysis, you can refer to our technical analysis series, which is coming up next, series 2 in the Free Money Glitch stock course. Okay, so this finishes off the second part of the Free Money Glitch fundamental analysis portion. Next, we will learn about the third part of fundamental analysis, share valuation. This is Bradley Barnett. I love y'all. From yours truly, Financial 4.